bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the June 23rd, 2026 episode. As our audience watching on YouTube can see, my guest this week is my partner, Jason Watkins. Jason is back on the podcast at a very interesting moment for opportunity zones. In fact, as we were preparing for today's episode, and we're recording on Friday, June 19th, we had planned to focus on what additional guidance Treasury and the IRS still needed to issue as we transition from OZ 1.0 to OZ 2.0. And there is a broad swath of guidance in a number of areas, including transition rules, that we believe Treasury should issue, and certainly we want them to issue in a number of areas. That said, just before recording this episode, the IRS released yesterday new transitional guidance in the form of Notice 2026-40. So this conversation that I'm having with Jason today is truly hot off the presses. We have had maybe 24 hours of time to review the notice and share our initial takeaway. This guidance gives us an early look as to how Treasury is thinking about the transition between prior law and the new framework under the One Big Beautiful Bill Act, more specifically with respect to gains that can be invested in OZ 2.0 tracks, or under the new rules, I should say, not necessarily under the 2.0 tracks, but also the treatment of expiring zones. It raises some important questions about how existing investments will be treated and how new investments should be structured, particularly if they're going to be investing in expiring OZ 1.0 tracks. So we have a lot to talk about today. We're not going to talk about the broad swath of guidance that we're waiting on and think Treasury should issue. We'll be very focused on this notice and these transition rules, because there's some critical deadlines that if you're a QOP investor or planning to be a QOP investor, qualified opportunity fund investor, and or want a qualified opportunity zone business, you're going to want to be very aware of these rules. As you can tell, there's a lot to cover today. So if you're ready, let's get started. Jason, welcome back to Tax Credit Tuesday.
Hey, thanks, Mike. Always happy to be on.
And thank you for being willing to jump right into this IRS notice after having had all of 24 hours to assess it and weigh it and consider it.
And you could really hear the brakes screeching on our planning for today's podcast as we pivoted to this new topic. But the good news is I guess we already have another podcast about ready to go, so we can look for number 10 soon.
Yes, indeed. Now, this is your 9th appearance on Tax Credit Tuesday, and we're going to go into the IRS Notice 2026-40. But before we jump into that, please quickly take a moment for those in our audience who are familiar with your work, some of the services that you provide to clients to help them navigate investing in opportunity zones.
I'm a partner in our Atlanta Metro office. I lead the OZ practice here at Novogradac, and I help investors and funds and businesses structure, manage their OZ investments, really provide a full range of early days consulting on these projects, even to determine whether the project can ultimately be eligible, talking about fund formation and structuring and those types of challenging issues. And then as the projects are going on, we provide the financial statement audits and the tax returns and compliance services and everything else you can imagine that might be necessary from an accounting standpoint for an opportunity zones deal. In addition to that, I also lead the Novogradac Opportunity Zones Working Group. Now that, and we'll talk more about that later, I know, but that's a really great collection of industry practitioners and consultants and many others, funds that are really heavily interested in helping to help design and steer best practices in the OZ industry, and also to advocate for changes to regulations or new regulations that can help the OZ incentives maximize investment in low-income communities.
Thank you for that. And I will include your contact information in today's show notes. So those in our audience that want to reach out to you, please do reach out to Jason for tax consulting services, audit services with respect to opportunity zones, as well as if you're interested in joining the Opportunity Zones Working Group. Unfortunately, this podcast is posting on Tuesday, hence the name Tax Credit Tuesday. But next Tuesday, we also will have our next Opportunity Zones Working Group meeting where this will be a critical topic. But we meet monthly. And if you reach out to Jason, we can get you to become a member and join the Opportunity Zones Working Group meeting in a month. And then every month thereafter, because there'll be a lot more to unpack with this notice as we have more time to think about it, distill it, better understand it, as well as identify a number of the gray areas, which kind of leads into the purpose of the notice itself. It is an IRS notice. It's not a regulation. It's a notice of intent to issue regulations. But with that said, what areas, Jason, do you think this notice is relevant in these areas?
It's really about investors and investments in the existing OZ 1.0 zones that were designated back in 2018 that ultimately are not redesignated this year. That starts in a couple of weeks, actually, that ability for governors to start making those nominations. What this guidance is, again, as you notice, it's an intent to issue regulations. It's not a notice of proposed rulemaking, which would be proposed regulations. So this is a notice, but it was something that a lot of folks in the OZ industry had asked for. Practitioners and developers and others need a lot of time to get these projects off the ground. And as we know that these zones are going to be expiring at the end of 2028, and these new zones start at the beginning of 2027, what are investors allowed to do? What investments are allowed to continue in these existing OZs?
That's exactly right. Because and obviously you led a lot of comment letters from the Opportunity Zones Working Group to Treasury, asking them for guidance as to how existing businesses continue to comply when their opportunity zone expires. If it does expire, it doesn't get redesignated, as well as if you're a business that is in process of coming online, how do you deal with all the various rules if your business is coming online at the time that the zone is expiring? That's the core purpose of this notice. But there's also a lot of other little pieces of the notice that are confirming, if you will. One of those had to do with the question about the fact that a chief executive officer could only designate or nominate, I should say, Treasury designates, can only nominate 25% of the eligible zones. And there was a concern about whether or not when you apply this 25% limit, do you have to take into account the previously designated zones as part of that 25% limit? Please share with the audience what the notice makes clear with respect to that question.
It makes clear that there are two different periods under which opportunity zones can be designated. So the first, beginning in 2018, runs through the end of 2027. The second set is starting in January 1st, 2027 for 10 years to the end of 2036, completely different set of 25% of the eligible census tracts. So long story short, that potentially tortured reading that we had identified as we looked through the statute originally, as expected, there will be two different sets of opportunity zones, and there's really no further issue there. That was really great news to see that in writings from Treasury.
I couldn't agree more, because I definitely think that was the better reading. But as you noted, there is a more tortured reading that could have limited that, which was great to see that clarification. We expected that was going to be there, but as you point out, seeing it in writing in some regulatory guidance was good. Now, before we get into the transition rules for current and planned businesses in OZ 1.0 zones, let's talk about options that investors have with respect to investing gains that they recognize in 2026. What are the choices that they need to be assessing as they consider investing in opportunity zones more generally?
Sure. So the real key number here is 180 days. For an individual taxpayer that has a direct capital gain, so let's say a taxpayer owns some stock, he or she sells the stock, that's a direct gain. They have 180 days from the date of that gain in order to invest up to the amount of the gain into a qualified opportunity fund and then defer the taxes on that gain. If that 180-day period ends during calendar year 2026, then those investors would be restricted to investing into an Opportunity Zones 1.0 era qualified opportunity fund, meaning that they would only be eligible to defer through the end of this tax year, through the end of 2026. And then the gain becomes taxable at that time. If that 180-day period will stretch into 2027, then the investor could wait until early 2027, make the investment at that time, and then be eligible for the Opportunity Zones 2.0, which is a 5-year deferral, a 10% basis step up for non-rural investments, or a 30% basis step up to rural investments. So there's a lot of benefit in understanding that 180-day window is really key here. Now, it changes substantially if the gain is coming from a pass-through entity. So let's say that the taxpayer was invested into a partnership or an LLC, and that partnership or LLC has a capital gain event. Because the investor is receiving that gain via a K-1 from that pass-through entity, the investor now has some optionality. That 180-day period can begin on one of 3 dates. It can begin on the date of the gain, that it happened at the partnership level. It can begin on the last day of the partnership's tax year, typically December 31st, or it could begin on the following March 15th, which is the due date without extensions of the pass-through entity's tax return. So a capital gain in a partnership that is passed through to an investor that happened even in January of 2026 would be eligible for that third date, March 15th of 2027, to be the beginning of the 180-day period. That would give an investor until approximately September 10th of 2027 to actually move the money of the amount of the gain they wish to have deferred into a qualified opportunity fund. There's a lot of optionality there. So those are the regular gain situations that we see.
Yeah, I want to go into another subset of gains that are more notable and a lot of our audience will want to know about. But I just did want to observe the fact that so much of your 2026 gains for most taxpayers, you can wait and invest next year. And by doing that, you get a 5-year rolling deferral, the 10% basis step up, potentially 30% in rural. Is one of the reasons why we were saying there's going to be this. Sometimes it was referred to as a dead zone, but not quite a dead zone in 2026 in investing. And our own data collection shows it's not a dead zone, but it definitely is a deadened zone. And we'll see a huge pickup in early 2027 in terms of investments in qualified opportunity funds for all of those who are waiting to invest their 2026 gains because they have the optionality of investing next year. So let's talk about the two types of gains. And this has to do with if I did invest already in an OZ 1.0 zone in a qualified opportunity fund, I will have to recognize my gain as a general matter on December 31, 2026, unless before December 31, 2026, I have what's called an inclusion event. So the question that clients are asking us is, if I have an inclusion event, something that triggers that gain recognition before December 31, 2026, can I reinvest that gain? And then secondly, if I wait until December 31, 2026, and I have this deemed inclusion event, can I reinvest those gains in a new opportunity zone? What say you? What says the notice, importantly?
What says the notice? My interpretation notice is actually very clear, but actual inclusion event, this is a return of capital or some other method that actually triggers an inclusion event, is eligible for a redefer with a new 180-day period. So an inclusion event during the second half of this year could potentially be eligible for redeferral through an investment into a qualified opportunity fund in 2027, and then eligible for these longer benefits, the 5-year deferral and basis step-ups. However, the notice is also very clear that a deemed inclusion, which would be just continuing to hold the investment through December 31st, 2026, is not eligible. And they gave good reasoning why. The statute actually states that basically a gain can't be deferred twice, that you can't have a gain subject to 2 different deferrals. And because that investment in a fund that is held through December 31st, 2026, even though it's taxed, is still eligible for that 10-year tax-free exit. That means that there is still an election in place with regard to that original capital gain. That's why it can't be redeferred. And they made it very clear in the notice, which was nice to see again in writing.
And as you observe, as a critical point is you hold the investment until December 31, 2026. That 10-year holding period continues beyond. You obviously don't have as many years left of the 10-year hold period. But if you do have an inclusion event and you redefer, you're starting that 10-year holding period all over again. So let's turn to what is really the core of the guidance. And as I mentioned earlier, it's the transitioning from expiring 1.0 zones. When I say expiring 1.0 zones, there'll certainly be a number of 1.0 zones that by Treasury after they get renominated by the governor. And we're not talking about those zones because that's just a continuation of being a qualified opportunity zone. We're focused on those zones that were nominated and designated after TCJA was enacted and are expiring either in Puerto Rico at December 31, 2027, or more generally across the country, December 31, 2028, and do not get redesignated. So give an overview to the audience as to the two sections in the ruling that address these transition rules with respect to businesses or proposed businesses.
Sure. So the general rule is that tangible property acquired after December 31st, 2026 has to be in a OZ 2.0 census tract. Has to be in the census tract that's been designated after passage of the One Big Beautiful Bill Act last year. That's the general. Now, there are two exceptions to that, essentially. One is that a qualified opportunity zone business would need to have a working capital safe harbor plan in place. And there's a bunch of rules around that we'll dig into in just a moment, I think. So that's the first, is that there is a valid working capital safe harbor plan in place by December 31st, 2026, not 28, 26. Because we know that the OZ 1.0 census tracts maintain their designation through the end of 2028. So this is a little bit of a departure here, but it's basically saying that for tangible property acquired after December 31st, 2026, you'd have a general safe harbor plan in place. Further exceptions are the regulations do allow for a replacement property or modernization property to qualify as qualified opportunity zone business property in the hands of a qualified opportunity zone business or a qualified opportunity fund. By replacement or modernization, these are purchases of tangible property that are necessary for the trade or business to continue in its active trade or business. It does not allow for expansion of an existing property or existing business. Any expansion is disallowed, and there's examples in this notice that lay these out pretty clearly.
Yeah, I think of this section, it talks about tangible property acquired after December 31, 2026. And let's first start with the definition of acquired, then we can come back to the other two tests. But when I think about it, it's like if you're not acquiring it by December 31, 2026, and you want to invest in this expiring zone and you haven't invested there yet, then you're going to have to be focused on this working capital safe harbor. And then the second part of the test, the replacement modernization, that's really just saying if you've already invested, then how do you treat replacements? We'll get into that in a moment, because obviously if you own an apartment building, you have to repair the roof and things like that. You want that property to be qualified. But let's start with the definition of acquired after December 31, 2026. Many listening might be thinking to themselves, particularly with respect to self-constructed property, if you're buying an asset, you know when you've acquired it, when you bought it, it took possession. But very few of OZ investments are just acquired property, generally in that sense, that hasn't been placed in service yet, but about to be placed in service. A lot of opportunities on investment is self-constructed property. So then you have to initially be looking at this ruling saying, with respect to self-constructed property, I have to have acquired it on or before December 31, 2026, or else fall under one of these exceptions. What is the definition of acquired under the Treasury regulations?
Here in the final OZ regulations, there's a safe harbor that was established for self-constructed property. It doesn't say self-constructed property within it, but there is a safe harbor that says that if 10% of the costs of the ultimate construction of self-constructed property have been incurred, that does not include land, it does not include pre-development costs. But once that 10% threshold has been met, then a taxpayer can choose to make that date, that 10% threshold is met, the acquisition date of the tangible property.
So under this part of the ruling, if you think you pass that 10% test, then with respect to the zone being an eligible zone for purposes of tangible property, you continue to satisfy, then you're okay. But if not, and you haven't placed the property and you haven't met this acquired test, you then have to meet this working capital safe harbor test. Now, many in the audience are probably saying, well, I already have a working capital safe harbor test, or I'm already familiar with those rules, but this isn't exactly the same. So share with the audience the 4-part test for a working capital safe harbor to meet this requirement. And just to emphasize, this is something that would need to be in place by December 31, 2026, which is why, to me, the headline of the notice is for clients that have properties that they're assessing now and businesses that are assessing now to invest in, they need to be thinking pretty critically about the importance of creating a working capital safe harbor that qualifies by December 31, 2026.
Absolutely. That's the flashing neon sign of this notice. So it's a 4-part test. First of all, a opportunity zone business that does want to continue to acquire property after December 31st, 2026 has to have a working capital safe harbor written plan and schedule in place, a valid plan by December 31st, 2026. Second prong is any property acquired under this working capital safe harbor needs to be done substantially consistent with the plan. The third prong, and this is where it gets a little more complicated because we're used to those two. But the third one is that the QOZB entity will have to have already received 10% of the ultimate amount of working capital that's going to be necessary for this construction of the project. And it has to have spent 5% of the overall ultimate cost of the property. However, there is no restriction on including land acquisition. There's no restriction on the pre-development costs here noted in here, like we have with that 10% safe harbor we were discussing earlier. Also, on the 5% span, it doesn't actually necessarily have to be money out of the bank. If the QOZB has entered into a binding agreement to spend 5%, then that also counts as having been incurred under the terms of this working capital, this 4-prong plan.
Let's turn now to the replacement modernization exception. So either you've acquired the property subject to this 10% test by December 31st, 2026, or else you've set up a working capital safe harbor. Those are the ways to address the zone continuing to qualify purposes of new businesses, if you will, or existing businesses that haven't actually been placed in service yet or started the business operations. Then there is also this exception for replacement modernization. This is something that the Opportunity Zones Working Group submitted comment letters. We gave examples about how you could have an apartment building that the roof needed to be replaced and you wouldn't want the cost of the roof to be ineligible property because the zone had expired. So explain this replacement or modernization and some of the implications of the fact that it says replacement and modernization are okay, but expansion is not.
Sure. They really went even a little further, I thought, on the replacement in that they even noted new appliances in an apartment building or new carpet or other things besides a major capital acquisition like a roof. So I thought that was great to see. I think that gives us a lot of confidence going forward. The modernization, again, that's really great to see. Say it's a manufacturing facility and they want to modernize their equipment. They're able to do that as long as that modernization is necessary for that business to continue to actively pursue its trade or business. So that's also great news. I think that gives a lot of comfort going forward that these existing businesses are going to someday not qualify because of necessary expenditures they've had to make in order to continue to operate. So that's great to see. The inability for a business to expand could really limit existing qualifying opportunity zone businesses from being able to expand really ever, as long as they still need to be an opportunity zone business and before the overall 30-year period is passed for OZ investments. And the reason why is because if a business expands, naturally, it will likely have tangible property acquisitions to expand. Perhaps it puts a second building next to its existing building. And under this exclusion, that second building wouldn't qualify. And if our listeners recall, the opportunity zone business is required to hold at least 70% of its tangible property as qualifying property. So if it suddenly has a bunch of new property that doesn't qualify, it can easily exceed that 30% maximum of unqualified property, and then suddenly the business qualifies. A qualified opportunity zone business that wants to expand will have to be very mindful of this inability to treat that new property as qualified.
I think that's a great point to be making about the expansion and the fact that it puts a theoretical cap on how much additional tangible property a business could be acquiring without violating the 70% test. So they have to be monitoring that. And they're definitely going to be structuring ways around that if a business wants to expand. It's just if you expand too far, whatever additional expansion will have to be structured in a way that's not eligible for the OZ benefits as a separate business. That's beyond the scope of this call. But I don't think it's something that's going to cause a business to not want to be eligible. It just means that as they expand, some of the expansion costs won't end up being eligible for the 10-year hold. But the value of the 10-year hold for the existing business that has been expanded a little bit will more than outweigh some of the other structural challenges. But save that for another call or reach out to Jason to explore that more. All that we just talked about is transition rules from my perspective, in the sense of how do I transition if I haven't already acquired the property, and I can use this working capital safe harbor. And we have now more guidance in terms of what investors can be comfortable investing in now versus the proposed businesses I really can't invest in now because it can't qualify under one of these routes. I like the fact that we have this modernization and replacement example that solved a lot of questions that existing businesses had and what we asked for as part of the working group. Now let's turn to the ongoing compliance tests. For existing businesses, and this will obviously apply to these businesses that are falling under one of these safe harbors and will become existing businesses, but for existing businesses, one of the questions was, if the opportunity zone expires, then how can the tangible property in the zone still be considered tangible property in an opportunity zone? And how can gross income and intangible property, they have their rules around how much gross income you have to be generating and how your intangible property must be used in an opportunity zone. If the zone expires, then you won't be able to do that. The ruling does create this safe harbor or this rule about what has to happen in order for you to still be treated as an opportunity zone for purposes of these three tests. So please explain what the compliance test, intangible property test rule is for purposes of continuing to treat an expired zone as an opportunity zone solely for this purpose.
Right. And I think the notice does a pretty good job of getting us comfort that tangible property that qualified will continue to qualify. I don't think there's really any questions around how that is structured. Within the compliance test, there's potentially an interpretation of the way it's written that, again, is one of those tortured interpretations that we talk about. But the way that this is written is that one of two things would happen. The business would need to be essentially placed in service and be in an active trade or business by December 31st, 2028. And then the second prong of that test is we rated by the end of its working capital safe harbor period that it would be an active trade or business, much like we currently have now. And as long as those two tests are met, that then the QOZB can continue to treat the location as if it was an opportunity zone for the purposes of all these compliance tests.
Yeah. And I think of it as for the tangible property to be treated as qualified opportunities on business property, it has to be acquired for use in an OZ before December 31, 2026, or has to meet one of the exceptions that we've talked about before. And that, as you point out, that's fairly straightforward. I do think it's a good point to mention the fact that under the rule for the gross income from an active trader business, the implication is that you have to begin the active trader business by December 31, 2028, or reasonably anticipate doing so. And this is a bit arcane, but there's a tortured reading that would suggest that under the working capital safe harbor, you have to reasonably interpret or reasonably expect that you're going to have an active trader business by December 31, 2028. I don't think that's the better reading of the section. I think the better reading is either you are in an active trader business by December 31, 2028, or you have a working capital safe harbor that you're complying with, such that you might go beyond the December 31, 2028 date to become an active trader business. And go ahead.
I think that reading is consistent with the earlier rules around qualified opportunities on business property and the ability to have a working capital safe harbor that could extend as far as 62 months beyond December 31st, 2026.
Right. But that's one of many areas where we're going to want to get additional clarifying guidance, because it's nice that you and I think that's the better reading. We really care what Treasury thinks is the better reading, which is a good transition to the next steps of the Opportunity Zones Working Group with respect to this notice. We'll be talking about this at the working group meeting on Tuesday, the Tuesday where this podcast posts, but share with the audience what our plans are. Similar to the screeching halt on today's podcast, same thing on the working group meeting where we had an entirely different agenda planned that is now scrapped for the time being, because we'll be talking about this and probably mostly this for the entire call. We'll be really reviewing this down to the word level, looking at everything from big issues that we've identified and then even minor things, just to make sure that we, as a group, fully understand. And then we'll start putting together commentary letters to share with Treasury what we think the impacts will be with some of the rules that are proposed here. Again, this is not proposed rulemaking. These are not proposed regs yet. Proposed regs are still to come. Generally, there's an open comment period when there are regulations that are proposed, but we will plan to comment prior to that and really go into detail on some of the timing aspects of this and what some of the applications could be and what some of the impacts could be down the road if these rules ultimately make it in as regulations. The wording in this notice says that they intend for the proposed regulations, once published in the Federal Register, would apply to taxable years ending after the date of this notice. So that would be starting next year, is what their intention is listed here. Now, that's a good point in terms of the proposed regulations. So with respect to the various sorts of issues, we'll obviously talk about the active conduct of a trader business. What are some of the other areas that you would be at? Obviously, there's going to be a lot more areas identified, but what are some other areas that you think the focus on the comment letter will be? I think a big focus on the comment letter, actually, I would like to back up and say that quite a lot of this notice is very much in line with the recommendations we previously made. So just delighted to see that so many of our recommendations that Treasury saw the same things that we did and incorporated those into this notice. That was great. I know there's going to be a lot of commentary on that requirement to have a working capital safe harbor in place by the end of this year, with the money actually moving into the qualified opportunity zone business in order for property to continue to develop in these 1.0 census tracts, to be acquired in these 1.0 census tracts. So that's going to be probably the principal focus of the letter, but we've identified some other things already that will likely incorporate into our commentary back to Treasury, and it'll be an interesting process. We'll be working on that very diligently over the next few weeks. I think it's good comments, because I definitely think of it as there'll be questions and these regulations and this notice that we'll want more guidance on. Then there will also be areas that the notice doesn't address that we think still need to be addressed, and fully expect that the proposed regulations would be more expansive, obviously, than the notice itself.
Absolutely. But I'm very appreciative that Treasury provided us with this notice in advance of proposed, because this does give practitioners the opportunity to start planning. If we found this out with proposed regs later in the year, that would be much less time to make some of this stuff happen if necessary. I'm very appreciative that they worked hard to get this notice out to us so quickly.
Hear, hear. I could not agree more. So, Jason, I appreciate you joining on Friday, June 19th, the day after the notice came out, to discuss these rules. I look forward to the Opportunities Working Group call we're going to have on Tuesday. And I want you to stay around for the off mic section here, but I do want to sort of transition to the end of this podcast. I want to say to our audience, if you got value for today's episode, I want to share with you 4 quick ways to support Tax Credit Tuesday and help more industry colleagues discover these insights. First, do subscribe to Tax Credit Tuesday on your favorite podcast platform or platforms. Second, visit the show notes for additional resources. Third, please share this episode with a colleague or colleagues. And fourth, please send questions or comments or ideas for future episodes to contact@novoco.com. Okay, Jason, let's turn to our off mic section where our guests get to share industry shout-outs. Please let our audience know who you would like to recognize today and why.
Sure. I would like to recognize Arteris Impact and Jonathan Tower. Arteris Impact is doing a really great job in the OZ space in pursuing affordable and workforce housing, which we know can be challenging sometimes because of the way some of the other incentives work in that space. They are really making it happen and making a difference in low-income communities. So I want to share that.
Great. Thank you. I echo that shout out. They've been involved in Opportunities from the beginning and make great contributions to improving low-income communities and providing housing for low-income community residents. So thank you for that. I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.